And Francis Tan, Chief Strategist, Asia at Indo-Suez Wealth Management, joining Lynn and I around the desk here at the SGX. Francis, great to see you. Good morning, and welcome back. Also a pleasure having you on the show. Your thoughts about the events of the past weekend?
Well, certainly brings a lot of concerns right now. Our market seems to be going to be more jittery, I believe, this week. Mainly because we do not know behind the game theory between US and Iran what more is there to come. And as investors with portfolios more heavily allocated in equities, I think it's time that they really relook their portfolio. And especially at the time whereby equities, even for the balanced risk profile, there's more centered on the US. In fact, US being a larger equity weightage in the portfolio. And at such a valuation right now, I believe this will be the week whereby investors who are getting a little bit more jittery on that may start to pan out.
Okay, so let's break it down and talk about exactly how your average high net worth investor and client should be rebalancing their portfolio. Underweight equities generally, or underweight U.S. equities specifically?
In fact, in the US since April this year, we have started to underweight equities in general as a broad asset class. The key component for the underweight in equities is mainly from U.S. equities. Okay. So across risk profile, from aggressive all the way to the conservative risk profile, we have highlighted a tactical underweight in U.S. equities, mainly because of the after post-liberation day, the big jump in the U.S. equities again. Markets seemingly not really influenced by all the negative things surrounding tariff or geopolitics, or even between Israel and Iran, seems to be a bit too high, I believe. So we decided to take some risk off the table. But that was even before what we saw over the weekend, whereby US entered this situation.
So are you telling clients to be even more underweight equities, and specifically U.S. equities now, or not?
Well, that's certainly. For now, there are some implementation lag. So for 1 to 2 months ago, when we started informing clients to start going underweight, you can't do it immediately. So I think it's going to be quite a long, drawn process.
Okay, good.
Francis, off the back of what we've seen at the weekend, I wanted to just get your comment on the Asian market reaction so far. So red arrows across the board, but as I said, between sort of 0.5% to 1% bar the TAIEX. Do you see that as market participants being too complacent at this stage for the risks ahead potentially? Or is it a fair assessment perhaps that Iran and its proxies are weak and therefore will come to the table and that there will be a resolution ultimately?
I certainly think that market is a little bit more complacent right now, but all depends on how the US is going to fare tonight, right? And over the next couple of days. I think this week will be quite a critical week, especially when if we see any form of retaliation from Iran against what has been done over the weekend, that could prompt even further jitteriness. So for now, I believe that for the rise in equities generally over the last 2 months, and investors sitting on profits, I do believe that the first mover advantage to maybe take some profits off the table will be on everyone's mind.
All right, I think we need to break it down in terms of the risks that the market faces and investors face from any sort of Iranian response, right? We've seen retaliatory missile strikes, very limited ones, on places like Tel Aviv, post the U.S. strikes on Saturday, right? Their ballistic missile capacity has been diminished. They still have some missiles left. They could use them, right, against U.S. military facilities, personnel, regional allies, and their oil infrastructure as well, even the Strait of Hormuz, and then they still have hypersonic missiles, which they have not used yet. So this could be done either directly or through proxies. For markets, is the biggest risk, not to say that, any strike on a U.S. base and military personnel is not dire or important, but for markets, would the biggest risk be what happens right there? Let's bring up that map, the Strait of Hormuz, whether or not Iran does close it or not.
Well, there has been quite a couple of reports going out to say that, well, for now, Iran has been sending most of the oil, not to the EU or to the US, in fact, to China. So I would say that if you have equity or even fixed income exposures to the US or even to Europe, I think that's quite okay because that will not directly affect you. In fact, it's going to affect China a lot more than the other parts of the world. But because of the potential closing of the Straits of Hormuz, and we have already seen how oil prices has been climbing, that will eventually impact a lot of oil importing countries around the world in terms of their renewed forecasts or expectations of how economy is going to be in the second half of this year. We are now at the juncture, and since the start of this year, many economies has been downgrading their forecasts already.
You know, you're an economist, right? And I know you would know this. You've probably been looking through it, the statistics over the weekend, right? China, I mean, look, sanctions on Russia, right? There have been workarounds, obviously, right? And places like China, like India as well, have been quite happy to buy heavily discounted Russian oil, right? The stuff that flows through the Strait of Hormuz that comes from Iran specifically, China buys 97% of that. What about Russian oil? Does that also move through the strait?
Well, that it depends. Well, it's a big question mark as well.
Yeah.
And we know there are shadow fleets also in the world right now, so it's really quite unknown right now. But I guess what's more important is that whether China has stockpiled enough over the last couple of months or last half a year in order to not be too overly impacted by the current rise in the Brent crude oil prices. But at the end of the day, I believe that economies around the world are going to seriously look at how this wave of higher oil prices may affect countries unevenly, because as I mentioned, the oil importing countries are going to be impacted a lot more. But of course, may not directly impact US as much, mainly because US average consumer, the expenditure on oil is not as big as what we saw 2 to 3 decades ago. It's roughly around 5% right now. Yeah.
Francis, I'm looking at the Brent crude price at the moment, $79 a barrel, so about 2.6% higher today and about 12% or so higher since the conflict first erupted between Iran and Israel. In your view, at what level does the oil price need to be for equity markets to start repricing significantly?
Okay, well, I don't think that equity markets will reprice as much in response to higher oil prices than to the uncertainty caused by these geopolitics that we're seeing right now, military or not. In fact, if going to answer your question directly, I believe anything above $100 mark will be. Mainly because the markets has seen oil prices above 100. It's quite in the recent memory that market has seen that. And this recent rise has got a strong reason to that. But OPEC is going to come in, and OPEC has got pretty ample supply of oil as well. So market will perhaps not adjust as much until oil prices move above $100. In the meantime, they are going to be a lot more concerned about how the interplay.
You know, we were talking to Vandana Hari from Vanda Insights earlier, an energy expert, and the part we didn't get to was what happens on the supply side. Right, that could potentially offset any closure of the Strait of Hormuz. So you mentioned OPEC Plus. They've been increasing production 3 months in a row now. That's positive. A lot of people are talking about how oil at, let's say, 80, right, is probably going to be enough to incentivize U.S. shale to get going again, which would add to production. And the last point I want to add is Iran itself, although their production has literally ground to a halt in the wake of the initial Israeli strikes, right? They do have significant oil storage, floating storage offshore, which they could sell for at least a couple of weeks if they wanted to. Again, so just wanted to bring that in there. What about bonds, though? Are bonds a good place to be in a situation like this, or not?
Well, certainly. I mean, bond in terms of a longer-term view at this part of the business cycle, irrespective of how the world is going to be like geopolitically, is going to be a lot more favored by us. In fact, we are overweight bonds as an asset class in a broad portfolio basis. But of course, we have to be selective across bonds. I mean, over the last couple of months, there has been a lot of pessimism surrounding U.S. debt. And in fact, the traditional U.S. debt as a safe haven hasn't really come true. I mean, over the weekend, what has seen, I mean, it will take perhaps the 1 to 2 weeks over the next 2 weeks to see how U.S. debt has been still a traditional safe haven, because I'm not seeing yields moving lower right now.
So I was going to say, right, you know, liking bonds means that you expect prices to go up, yields to go down, and I'm wondering whether that assumes that we're not going to get a huge inflationary kick from oil shooting up to 100 or past, meaning Iran's not going to close the Strait of Hormuz. And two, on the fiscal side, in the U.S., whatever passes through the Senate is not going to be as inflationary as a lot of people initially feared.
Oh, yes, certainly. As I mentioned just now, the average consumption on oil as a percentage of your total U.S. household expenditure is only 5% right now, compared to 15% perhaps 2 decades ago. So the average U.S. household is not so exposed to the prices of oil, or it's not so inelastic. So basically right now I will feel that in fact the inflationary pressures could be not as muted until oil prices move above $120, for instance, right? But that Martin, you mentioned just now, if oil prices goes above $80 or even $90, shale producers will come in again. Yep. And that dynamic equilibrium across all the oil producers around the world may mitigate any further rise in global oil prices.
Yeah, just to recap, energy experts we've talked to reckon that the geopolitical risk premium on top of oil built into the oil price now is about $10 a barrel, meaning if you net off the 3 concurrent simultaneous wars we've got going on right now around the world, oil should be theoretically about $10 cheaper. So instead of 75 on front month, maybe 65, and on crude discounted by $10 as well. But I mean, this is all in a theory. What about gold, Francis?
Well, we are positively gold during this part of the business cycle.
Even at these levels?
Even at these levels, hold on for a while. It really takes some technical analysis.
Not silver?
Silver has been having a catching up gold right now, of course. So both gold and silver, we are positive. But mainly for gold, we prefer to buy on dips for now. Mm-hmm.
So, I want to get to exposure to China, whether it's equities or paper or anything else, right? Given what we've been talking about this morning, how China has been aiding and abetting Iran and its ballistic missile program, whether or not that could lead to more sanctions and export restrictions and the like, what do you think?
Well, it's always a possibility of that being one more factor that increases the tension between U.S. and China. Right, China and Russia now, they are condemning the strikes on Iran. Yeah. So we can clearly see the world is divided into 2 halves right now. The two big boys and their own exclusive clubs right now. So going forward, if the tension is going to continue because of Iran, I think that will cause more concerns, across the board.
Just quickly, we've seen the dollar getting a bid, perhaps it's on those safe haven flows. But the Japanese yen is also traditionally seen as a bit of a haven bid, but we're not seeing that this morning. Do you think that the Japanese currency is losing its status as, a place, that people go for?
No. I believe there are a couple of currencies around the world that continue to be attracting safe haven flows, especially what's going to conspire over the next 1 to 2 weeks in terms of the reaction from Iran. The Swiss can be one safe haven flow, although SMB, of course, cut rates to 0% right now, right? But they are still a traditional safe haven currency. Japanese yen, US dollar has been hit quite a bit, the DXY, and perhaps for now, in terms of value as a safe haven, is cheaper than the other 2 currencies. And of course, where we are in Singapore dollars can also be quite a good safe haven as well.
All right. Dollar Sing, SGD, understood. Francis, listen, always great value talking to you. Thank you for coming out today. Appreciate it.
Thank you very much.
Keep safe and come back to see us again very soon. Francis Tan there from Indo-Suez, and Lin, part of the conversation as well.